Hi, this is Mark Pizzacalla. Welcome to 3 Minutes with Mark, special Chinese New Year edition, Year of the Horse, and hopefully it looks favourably upon you. But what I want to talk about today is the RBA's decision to cut interest rates. I want to talk about property, inflation, and restructuring your debt. What's so exciting about that, you might say? Well, there's a lot going on. In short, Australia's inflation rate rose 3.8% in the 12 months to December 25. CPI rose 3.4% in November, and all of that added to expectations of a rate rise, and that's exactly what the Reserve Bank did yesterday. Its first meeting in February decided to increase the cash rate to 3.85%. That's a 25 basis point lift, I should say. Nobody was surprised about that, and all the commentators were suggesting that, look, there was going to be some sort of rate increase. Now, that's a crazy position when you think about the RBA has gone from cutting rates to now increasing rates, and it's the first time it's increased its rate since November 23. Now, the statement released by the Reserve Bank was quite interesting. It said that the board judged that inflation is likely to remain above target for some time. So that's a strong message to householders. And also, like, what does it mean for Australia's property market, which some are saying is continuing to buzz along nicely, particularly in states or in many of the states. So is it enough to curb those prices? Well, if you have a look at the impact on a $600,000 loan size, it means $90 extra a month. On $1 million, it means $150 a month. That could impact buyer behaviour. Personally, I don't think it's going to be sufficient to materially impact behaviours. Of course, that depends where the households are at. Some economists have predicted that the RBA will continue to increase the rates based on what they said in their report. Also, it means that there's going to be a maximum borrowing capacity issue too for investors and those looking to buy their first homes as well. Coupled with that, you've got to look at the supply-demand equation with property. You can't ignore that. If there's a supply-demand issue, that will also impact that buying decision and how much you can buy for. Mortgage stress, well, that's an interesting one. Over the over the holiday period, I had a look at a number of podcasts and so forth. And look, in the first quarter of 25, one of the reports indicated that those showing mortgage stress were those that had in excess of $1 million, were the greatest $1 million loans, were the greatest percentage of arrears, which I thought was interesting. But if you think about it, it makes sense, because if during COVID they borrowed large sums of money to buy a property, thinking interest rates are going to remain low, thinking the property prices are going to double, and if that hasn't happened, you can find households being in trouble, even those that are on six-figure incomes, dual income families. One of the people loses their job or for personal reasons decide to have children, one income leaves the family. That can be quite devastating, even at large income levels and even at large property purchases. So then let's talk about debt financing. Now, you need to be really careful here. In the private sector, do not mix your business debt and your private debt. Quite often I see taxpayers getting this wrong by actually refinancing out of what I call tax deductible good interest into non-tax deductible interest, which is bad interest. Example, they use loans for mixed purposes, for business and private purposes, and you need to apportion that to the deductible component that relates to what is earning you assessable income. A lot of people ignore that or don't do that or don't know they need to do that. The other thing too is that as people refinance, what they do is they have paid off a loan, so they've paid off a $500,000 loan to $300,000, and then they decide that now they're in trouble. Interest rates are going up. They need more income or more access to funds, and so they refinance. But in refinancing, if you're refinancing back up to 500, if that was a tax deductible loan for, say, an investment property, and you refinance up and using that for personal reasons, that difference of 200, well, then again, that's bad interest that you're going to incur. You cannot deduct that. You can't double dip on your tax deductible interest. Look, that's all I want to say today. I've said a lot. Hopefully you found that useful. If you have any queries, though, by all means, give me a call, and wishing you all the best for the Year of the Horse. Happy Chinese New Year to everybody out there.